Welcome to Talk Tickers, your shortcut to staying well-informed on the latest corporate insights. Today, we're taking a deep dive into Volvo Group's second quarter 2025 earnings call.
Yeah, and it's a really interesting one. It's not just about the numbers, is it? It's about how a massive industrial player is dealing with, well, two pretty different situations at once.
Exactly. You've got this kind of turbulent but maybe resilient market today, and then this ambitious but maybe slower than hoped for shift to future tech.
That's right. The macro picture this quarter was quite divided. We saw some stabilization in Europe, which is good news for demand over there.
But then North America, still a bit hesitant.
Definitely. A real wait-and-see vibe from customers. Lots of uncertainty hanging around. It's like two different economic climates playing out.
So our mission today is to unpack how Volvo managed that balancing act. We'll look at the financials, what's going on in different business units, and what it all means for the wider market.
Sounds good. Let's get into it.
Okay, so let's kick off with the headline numbers, a quick snapshot. Net sales came in at 123 billion Swedish krona, or SEK.
Right. Now, that's down 12% compared to last year, but you have to factor in currency. Adjusted for that, the drop is more like 5%.
And that was mainly driven by selling fewer trucks, right?
Primarily, yes. Lower truck volumes were the main factor there.
But despite that sales dip, their adjusted operating income looked, well, pretty solid. 13.5 billion SEK.
Yeah, really solid. That gives them an 11% adjusted operating margin. And that word adjusted is doing some heavy lifting here.
Because it strips out some significant one-off things.
Exactly. It gives you a clearer picture of the core business profitability away from those unusual items.
And cash-wise, they seem pretty strong.
Very much so. Cash flow for the quarter was 2.9 billion SEK. That bumped up their net cash position in industrial operations to 43.1 billion SEK. That's a healthy cushion.
And their return on capital employed? Still looking good.
Yep. 25.7% on a rolling 12-month basis for the industrial side. Shows they're using their assets effectively. Earnings per share came in at 3.64 SEK for the quarter.
Okay, but we need to talk about those adjustments. What were the big one-time items that weren't in that adjusted income figure?
Right, there were two really significant ones. First, a big negative hit, 4.5 billion SEK, because this whole shift to zero-emission vehicles is just happening slower than everyone expected or maybe hoped.
Slower than they anticipated in their planning, specifically.
Precisely. So that charge breaks down into 1.6 billion for writing down the value of some battery electric assets. That's the impairment. And then 2.9 billion in compensation paid to Samsung.
Why Samsung?
They had big battery volume commitments, and since the transition is slower, they renegotiated to reduce those volumes.
Yeah.
That cost them, and it also hit cash flow directly by 1.9 billion SEK in Q2.
Ouch. That's a substantial impact from that slower transition. Was there anything on the positive side?
Yes, there was. A positive 1 billion SEK gain from creating Corda. That's their new software-defined vehicle platform joint venture with Daimler Truck.
Okay, so a big negative hit from the EV transition speed, partly offset by gain from the software JV.
Exactly. And that's why, despite those large swings, management could still frame the quarter as one of strong resilience and solid earnings.
It suggests the core operations are holding up pretty well underneath all that noise.
That's the takeaway, I think. Operational discipline really shone through.
Okay, let's dig a bit deeper into those sales numbers. Overall, currency adjusted, down 5%. We know vehicle sales dropped 6% because of trucks. But services?
Services looked good, up 2% currency adjusted, even after accounting for some divestments. That recurring revenue is just so important, especially now.
A real stabilizer. And regionally, how did it break down?
It really shows that fragmented picture. Europe was down 5%, which sounds bad, but it's actually a smaller drop than they'd seen recently. So maybe signs of stabilization there.
But North America took a bigger hit.
Yeah, a significant 10% decrease. Lower demand for trucks and construction equipment there. South America was also down 9%, mostly trucks again.
Any bright spots?
Asia, actually, up 7%. Seems like trucks and construction equipment had good momentum there, really highlights the different speeds in different markets.
And currency wasn't helping either, was it?
No, definitely not. A negative impact of over 10 billion SEK on the sales line. The US dollar weakening against the krona was the big driver, about a 3.4 billion SEK hit just from that.
Okay, so turning to the adjusted operating income drivers, what helped and what hurt?
On the plus side, they managed operational expenses well, kept those lower. And as we said, the service business performance was strong. That provided a real cushion.
And the negatives?
Primarily the lower truck volumes hitting profits. And within construction equipment, they had an unfavorable mix selling more in less profitable markets or segments like China.
What about tariffs? Are they starting to bite?
They mentioned costs related to tariffs started to build in Q2, but the impact on the results so far was limited. They expect more of that to come through later.
Any forward-looking guidance on costs?
Yeah, for the full year 2025, they guided for a positive net effect from depreciation and amortization of around 3.5 billion SEK. But on the currency front, it's still a headwind.
How much?
Well, it hit operating income by 2.3 billion SEK negatively in Q2. And for the full year, they expect around a 4 billion SEK negative impact just from their transaction exposure, buying and selling stuff across borders.
Got it. And cash flow, again, 2.9 billion operating cash flow. You mentioned investments and the one-offs impacted that.
They did. Investments remain high, which is necessary for the future. And those one-time items, especially the Samsung payment, definitely weighed on it.
But still positive cash flow.
Still positive, yeah. Even with inventory and receivables ticking up slightly. Strong underlying earnings and also some favorable timing on payments they owed helped keep it in the black.
And that solid net financial position of 43.1 billion SEK remains intact even after paying out dividends.
Exactly. It shows their financial management is quite disciplined, building that resilience even while investing and returning cash to shareholders.
Okay, let's move into the different business areas. This is where you see the nitty-gritty.
Absolutely. First up, Group Trucks. Currency-adjusted net sales down 7%. Lower volumes, as we discussed, but also some negative pricing impact on new vehicles.
So margins squeezed there.
Yeah, operating income and margin took a hit from the lower volumes, higher material costs, and also some overcapacity issues, especially they noted in North and South America.
But again, saved by cost control and service.
That seems to be the theme. Good cost control and the strong service business helped keep the earnings resilient, even with those pressures.
Okay, what about construction equipment?
Net sales there, currency adjusted, were actually up 1%, so slight growth.
But operating income was down.
It was, down to 3 billion SEK. The main reason was a negative mix effect. They sold higher volumes in China, which tends to be lower margin, and that offset some benefits they saw from lower material costs. Still, the adjusted operating margin was decent at 13.1%.
All right. And buses.
Buses also saw a 1% increase in currency-adjusted net sales. That was driven by better pricing, both on new buses and in the service business. Adjusted operating income held up pretty well at 474 million SEK, despite lower volumes, again thanks to pricing.
No, the star performer.
Volvo Penta, really impressive. Currency-adjusted net sales jumped 12% to 5.5 billion SEK. Just a very strong quarter.
And the profit.
Even better. Adjusted operating income hit an all-time high for a second quarter, 1.1 billion SEK. And the margin was incredible, an all-time high of 20.7%.
Wow. What drove that?
Strong volumes, particularly in their industrial segment, think power generation. And they mentioned regaining momentum in the commercial marine business too, just firing on cylinders there.
And finally, financial services, keeping things steady.
Yeah, steady growth. The currency-adjusted credit portfolio grew 5% to 264 billion SEK. Importantly, the portfolio quality remains good delinquencies. Write-offs are under control.
Profitability there.
Adjusted operating income was 980 million SEK. Portfolio growth helped, though they did increase credit provisions a bit. And interestingly, new business volume hit a record for Q2 at 27.8 billion SEK, showing strong demand for financing.
That's a great breakdown. So, stepping back, what does all this tell us about their strategy and how they see the market evolving?
Well, let's look at the key truck markets. For North America, they're sticking with their 2025 forecast of 275,000 units.
Even with the slowdown.
Yeah, they say dealer inventory is supporting the market for now, but actual production is being kept low because of that wait-and-see mood we talked about.
Driven by regulations and tariffs.
Exactly. The upcoming EPA 27 rules and the tariff situation are creating uncertainty. So Volvo's adjusting production schedules carefully to avoid building up unsold trucks, minimizing that under-absorption cost.
And Europe, still looking more stable.
Much more so. The 2025 forecast there is unchanged at 290,000 units. Truck usage is good, and it's still mostly a replacement market, people needing to replace older vehicles.
Order books looking healthy.
Very. The European book-to-bill ratio was 94%. They said Q3 is basically full, and they're already taking orders for Q4. That signals pretty solid, stable demand. And their market share is strong. Volvo and Renault trucks combined have nearly 60% of the medium-heavy market and over 57% in battery electric trucks specifically.
On global trade, are they shifting strategy due to tariffs and uncertainty?
They're focusing on strengthening regional value chains, making things closer to where they sell them, but also using their global scale where it makes sense. They see transport logistics generally as a growth area for years, especially with new investments popping up in defense and infrastructure, particularly in Europe.
Which brings us back to electrification. That big charge suggests a real speed bump.
It does. They were quite clear. The societal shift is slower than they planned for. Underlying demand has cooled off a bit, still mostly driven by early adopters, the enthusiasts.
But orders were still up.
Yes, that's the interesting part. Orders for fully electric vehicles were up 59% group-wide, and electric truck orders specifically up 53%. A lot of that growth, though, was driven by their SDLG machines in China.
So the message is, the tech is there, the orders are growing from a low base, but the broader ecosystem needs to catch up.
Precisely. They stress the need for policymakers and others to really push for things like charging infrastructure and incentives to stimulate demand. The industry can't do it alone.
And related to that, they're making some strategic portfolio moves.
Definitely. A big one in construction equipment is selling their majority stake in SDLG in China.
Why divest that?
It seems like a strategic refocus. They want to concentrate the Volvo brand on higher value segments in China, rather than the mass market where SDLG competed. But they'll still leverage the Chinese supply base for global needs. It's about focusing resources.
They're also buying some dealer operations.
Yes, acquiring Seon's dealer network in Sweden, Germany, and the Baltics. That strengthens their service business and gets them closer to the customer to sell complete solutions, not just the truck or machine.
And investing in production.
Right, specifically in crawler excavator production in South Korea, Sweden, and the US. The goal is better resilience, shorter lead times for customers.
Any other innovations highlighted?
Autonomous solutions hit a big milestone, hauling over 1 million tons of limestone autonomously for a customer in Norway. Shows that tech is really proving itself in specific segments like mining.
And that Corda joint venture with Daimler.
Launched and operational, setting a new standard for software-defined vehicles, which is crucial for future features and efficiency.
Plus, a nod to sustainability with that EU funding for the Torslanda plant.
Yep, up to 49 million euros from the EU Innovation Fund for their Carbon Smart Factory project. Shows commitment to net zero in their own operations.
Did anything else jump out from the Q&A session afterwards?
A couple of things. Regarding North American market share, they confirmed that even though their orders were down 16% year-on-year, the overall market was down 40%. So they actually gained share significantly.
How do they manage that?
They attributed it to the successful launch of the new Volvo truck models, Mack having a better supply chain situation, and importantly, adjusting production early to match the weaker demand, which competitors might not have done as quickly.
What more did they say on tariff impact?
Confirmed costs started showing in Q2, limited impact so far, but expect it to increase in Q3 and Q4. They're trying to use pricing to offset it, but expect a net negative hit initially just because of the time lag.
In their balance sheet philosophy.
Just reiterated their commitment to keeping it strong, need that strength to handle the industry cycles, fund all this innovation, and keep shareholders happy with returns. Discipline is key.
And finally, the European outlook sounds quite positive still.
Very much so. Production levels are up and stable. Q3 is booked. Q4 orders are coming in. They expect demand to stay robust and pricing to continue improving there.
So if you tie all this together, what's the big picture for investors or anyone watching this sector?
Well, I think it really shows Volvo's agility in navigating this split market reality, cutting back proactively in North America while leaning into the stability in Europe. That's smart management.
And the electrification charge.
It's a big flag, isn't it? It highlights the real risks and the dependency on policy and infrastructure for this whole transition. It's a key challenge for the entire industry, not just Volvo. How much do you invest ahead of proven demand and infrastructure?
The service business strength stands out too.
Across the board. Yeah, it's just such a critical earnings stabilizer when equipment sales fluctuate. And those strategic moves, selling SDLG, buying dealers, show a clear focus on strengthening the core high-value parts of the business and getting closer to the customer. Building resilience.
Right. So for anyone assessing companies in this heavy-duty space, these dynamics managing regional differences, the EV transition risks, service strength, strategic focus are really key things to watch, aren't they? It shapes the future growth drivers and the potential pitfalls. Okay, let's pivot to our not financial advice segment. Please remember, these are just speculative ideas for discussion, definitely not recommendations. Do your own research.
Absolutely. So based on what we heard, here are a couple of, let's say, outrageous but plausible trade ideas.
All right, let's hear them.
First idea, the U.S. regulatory and destocking arbitrage. Given that persistent wait-and-see mood in North America, the EPA 27 uncertainty, the destocking, you could theoretically consider a short position on companies heavily reliant on the North American heavy truck market.
And pair that with.
A long position on truck makers who are more focused on Europe, where demand looks stable, replacement-driven, and order books are full. You're basically playing the divergence between the two regions and that specific U.S. regulatory cloud.
Interesting. What's the second idea?
The Penta power play. We just talked about Volvo Penta's stellar performance record results, fantastic margins. It's clearly a high-growth engine within the group, particularly in industrial power and marine, and pushing sustainable tech.
So the play is?
Speculate on a longer-term view, maybe a sum-of-the-parts valuation argument, or even an activist angle. The idea would be that Penta is potentially undervalued within the larger Volvo Group, and spinning it off as a standalone company could unlock significant shareholder value. It's a real gem.
Intriguing ideas, definitely food for thought. Okay, let's wrap this up.
Sounds good.
So to recap, Volvo Group put up solid results this quarter, navigating some pretty choppy waters. They showed strategic flexibility, leaned on their strong service business, and kept investing, all while dealing with global uncertainties and acknowledging that electrification shift is taking longer than hoped.
Yeah, they're clearly maneuvering from a position of strength, balancing today's realities while trying to stay positioned for whatever comes next.
Which leaves us with a final thought for you, our listener. If this gap persists, if policy support for EV infrastructure and demand keeps lagging behind the industry's investment and capability, how might that force heavy-duty manufacturers to rethink their capital spending and product plans in the coming years? Something to mull over.
Definitely a key question for the future.
Thanks for joining us for this deep dive on Talk Tickers. Until next time, keep exploring these vital industry trends.